You have questions, we have answers. This is Jane Muller.
And this is Ken Muller. Welcome to our show, all about real estate with Ken and Jane. Today, we have as our guest Dr. Jonathan Sternesky, who's the Director of Policy and External Affairs, and Jordan Moskowitz, the Managing Director of Single Family Programs. Both are with the New Jersey Housing and Mortgage Finance Agency. Gentlemen, welcome to our show.
Welcome.
Thank you for having us.
Thank you for having us.
Oh, it's our pleasure. So before we get started talking about all the great initiatives that you guys do, please give us a brief bio on your role with the agency.
Sure. So as you mentioned, I'm the Director of Policy and External Affairs at the agency, which means I run the policy and the marketing teams. So more often than not, when my teams do data analysis, policy research, program development research, we do legislative outreach, and then pretty much all like communication. So press releases through like managing the social. So whenever the agency is developing programs, or policies, or revising them as such, or frankly talking about them externally, like we're doing today, it more often than not is my team. Someone on my team is usually involved in almost all of that. So I've been there for about 6 years. And thank you guys for the invitation. Because prior to that, I actually was the economic development officer in East Brunswick, where I got to know you guys, but especially Jane, when we formed the East Brunswick Regional Chamber of Commerce.
I tell you, until today, everybody from East Brunswick Regional Chamber of Commerce. Missing you. Thank you. We all love you. Yesterday, when we had our party, I said, I'm going to see you. Everybody said,
their eyes,
say hi. Everybody
even
love
Rob,
you.
the current
Rob
position,
Sacrament.
he just said to say big hello to you. Yeah, everybody has such fond memories and speaks so
I
highly
also-
of you.
I
We miss you, but you're just around the corner. You went on to,
Yeah, very, very appreciative what you've done for us and starting the organization. And it's, like you said earlier, it's going strong, which is fantastic. Yes, very grateful.
And then we have
Jordan. Yes.
That's all right. Well,
it's a love fest for me.
And I'll continue because the Chamber's loss really is the agency's gain, because Jonathan's kind of underselling just how much his team does. They really do a wonderful job. My team, what we do is we operate as a small mortgage company inside of the housing agency. So we do down payment assistance programs, first-time homebuyer programs. We connect needy homebuyers with counseling agencies, and we also ran the state's homeowner assistance fund program, which is federal dollars that was passed to each of the 50 states, and we helped get that money out to those people that needed it in order to maintain their homes. And I work very closely with Jonathan's team. His team really helps with the data and publishing dashboards and being able to communicate our message both with the data, and then also my business development team, which works primarily with business to business, trying to work business with lenders, works very closely with his marketing and communications team. So Jonathan and I talk pretty much every day.
Right. So we're going to get into some of the details of some of the programs and who can qualify for it. But I was reading your website. So basically, in essence, in a nutshell, the agency provides access to affordable housing for moderate and low income families, New Jerseyans, along with also you guys do a lot for individuals with special needs. You've had projects where you built a affordable housing unit that had autistic families in it. So it's really just a great agency to reach out to all those New Jerseyans that need that qualify.
Thank you. Yeah, it's honestly really meaningful work, and when we are looking at programs, policies, everything is really about always like kind of what the impact that we're able to have on the residents of New Jersey are. And just kind of some background, the agency is this year was celebrating its 40th anniversary, the 40th anniversary of its creation, which was done by a merger of the New Jersey Housing Finance Agency and the New Jersey Mortgage Finance Agency. One of those was focused on single family, the other on multifamily. 40 years ago, there was a merger, and it was put, the idea being that having a unified agency that was focused on not just what we would say is, affordable housing or, like housing that has deed restrictions on it, but also making, increasing access to housing that is affordable. So trying to not only create housing where there are, maybe income restrictions on it, but also housing that is just cheaper to access for individuals, even in a non-deed restricted way. And we have, two main functions. On the multifamily side, we have what's called the low-income housing tax credit. It's a federal tax credit that we allocate annually that is used to incentivize private development or private investment into affordable housing construction. We do bond financing. We have the Special Needs Housing Trust Fund, which specifically buys down affordability so that some of these affordable units can be reserved for individuals who have specialized needs or need supportive housing. And then Jordan will talk a lot more about it, but we have single family programs that where we offer mortgages and down payment assistance to first-time home buyers, low and moderate income home buyers. We now have a first-generation home buyer product. And then we have programs that actually, give really low interest rate mortgages to police and fire, active members of the police and fire. And then, as Jordan mentioned, we also ran a lot of our COVID relief. Just as a kind of a broad impact statement, roughly 1/3 of all affordable units in the state of New Jersey are LIHTC units or low-income housing tax credit units. And roughly 9% of all multifamily renters in the state of New Jersey who live in multifamily buildings are actually residents of properties that the agency has financed or has some level of involvement in. And then right now, I think about 10% of the single family market is accounted for as our mortgages or down payment assistance right now is probably about 10% of the single family
of the first time home buyers.
First time home buyer.
Wow.
market, yeah.
We're really focused on workforce housing. I mean, it is really, especially on the mortgage side, right? Because cops and firefighters, teachers and nurses, first-time home buyers, trying to get people on that ladder of home ownership.
Wow, that's great. So you must have a tremendous budget every year. I'd be curious to know how many millions of dollars, which is great. You're getting it through bonds, through different sources. But
so I mean that's the fun part. The agency is self-financed. We through debt, through public financing, the loans we provide to on multifamily construction or the permanent loans once they're complete if they have deed restrictions on them through Jordan. And I cannot stress enough how much the single family product has grown since Jordan's been with the agency actually probably just a few months longer than I have.
6.5 years, yeah.
But he really grew that to, I think at this point that's about almost a third or half of our bonds each year are single family.
Yeah, we issued this year about $250 million of bonds for single family programs, and our total origination volume will exceed $1 billion of single family mortgages
over the
this
last
year.
6 years. Wow.
No, each year.
Because we use the bond revenue, but I also have relationships where we sell to Ginnie Mae and to Freddie Mac, just like any other mortgage company would. That's why I said we're kind of like a little mortgage company inside of a housing agency. My background really is in the private mortgage industry before I came to the agency, and we've started our relationship with Freddie Mac, and so we rely on tax-exempt municipal bonds to get low interest rates, but we also access the secondary markets for programs like the HFA Advantage program, which Freddie Mac has put out on a national level, and that doesn't require state funding to do so. We make the money from the bonds, or we make the money from selling loans in the secondary market, which fund our operations.
Yeah, and then we do very similar stuff on the multifamily side. So, like our operational budget is almost entirely financed through our programmatic means. That doesn't mean we don't get money from the legislature. In fact, over the last couple of years, we have received from the, we're extremely thankful to the legislature and the sponsors of those bills, but we have received money specifically now that underwrites our down payment assistance. So the down payment assistance is basically the legislature appropriates money for that, and that goes in and out. We're really minimal admin costs on that. It's money comes in, money goes out to home buyers. And then in the last 2 budget cycles, we have received a very significant amount of money. But again, operationally, it's just running through our existing programs. So it's money comes in, money goes out on programs. Like we're not, it's not coming in to fund the agency's operations. It's money that's coming in and that we're able to push out into the development world or to the homeowners. So in the last 2 budget cycles, we've received over $500 million of gap financing for multifamily construction, and that's the Affordable Housing Production Fund, the Urban Preservation Program, and the state's first dedicated statewide workforce housing program to create rental workforce units that are going to have a little bit of a higher AMI. So we pair that $500 million into various projects with low-income housing tax credits, and it's creating somewhere creating or preserving almost 5,000 units, totaling probably about $2 billion worth of production value for the communities that they'll be in. And again, like that's all, and that's outside of our standard, like normal, what we do normally. So that's all over and above our production.
Yeah.
Wow.
Yeah, and it's really a win-win because by doing all these initiatives, you're also creating a lot of jobs. There's construction opportunities. There's employment opportunities. You're helping people obtain home ownership, which is through these great programs, which we're going to talk about. So there's a lot. It's a win-win for the whole New Jersey economy, not only helping people better their livelihoods, but also the economy. So it's really a commendable program that you guys are involved in.
Wow, wonderful.
So let's talk first about affordable housing, and then we'll switch over to Jordan and talk about the single family. So with affordable housing, what do you see now as some of the bigger challenges that your agency faces with the affordable housing in New Jersey?
So the biggest issue is New Jersey's awesome, right? Like people want to live here. No matter really where you are in the state, you're an hour from anything, right? You may be an hour from or less from New York City, an hour or barely, maybe a little more from Philadelphia, beaches, hiking. There's just basically almost anything you can imagine. You're really like an hour away from. So New Jersey has really prime location. The issue is, we're also a pretty small state. So a lot of people want to live here. There's not a huge amount of available land. And when the demand exceeds the supply, pricing goes up. So land costs are fairly expensive. And then also in the aftermath of the Great Recession, we saw a huge decline in construction. That's for a variety of reasons, but there was a pretty significant decline in construction nationwide in the immediate aftermath of the Great Recession. And so we're basically missing a whole bunch of units that should have been built decades ago, or at least, only like 10, 15, 20 years ago. And more people are moving here. So I think in the last census, we gained 500,000 people. And the production of the units didn't keep up in time. So we could start building something today. Those units aren't going to come online for 2 years. It takes time to build. So we're engaging, in this very significant investment, as I mentioned, $2 billion worth of construction over and above our standard annual production amounts, which usually trend about $1 billion of production value each year. So we're trying to do that, but again, it's going to take a few years for those units to come online. So demand far outpaces supply. Right now, I think we see there's about a shortage of about 200,000 affordable units in the state. So each year we're trying to get a couple thousand to chunk away at that each year. And the legislature's been a great partner in that, in really trying to provide those financing.
Yeah, that's good. Sure. So we're going to continue talking about that. We're just going to take a short break, and we'll be right back after these messages. Okay, welcome back. So, Jonathan, let's continue our discussion with the affordable housing. And my next question is, how do you guys work with the local governments in reaching these affordable housing goals?
So our goals are to always trying to meet mutually beneficial goals. So we know that, under the Mount Laurel Doctrine, many towns have obligations or, numbers that they have to try and meet. So what we've done over the last few years is actually created a number of programs that can either help these towns. We basically have made funding available. If you have a fully affordable deal that is, fully affordable project that is, you can't find funding elsewhere, you come to us. We have our we have the LIHTC, and then we have what's called the Affordable Housing Production Fund, which is the gap financing. It makes these deals pretty much viable right off the bat, or very close to it. And maybe there needs to be a little bit of money that comes from the town or other lenders or whatever. But it becomes very viable to do. And so we're seeing towns. Actually, the demand is now actually at this point exceeding the amount of funding we actually have for that. So because many towns are trying to get to their get their third round obligations done ahead of any fourth round that comes out of that bill, the A4 bill that the legislature passed last year or earlier this year. And we're gearing up to try and provide more programs like that can help towns meet their goals. One thing I want to note is we don't do anything without the town's commitment in there. So if anyone is coming to us for financing, they actually have to have something called a resolution of need, which means the council has passed a resolution affirming that they actually want the project, that they support it, and that they need it. So if anyone has to come to us, we don't provide financing without that municipal sign off. And so it's really about trying to help them meet all of their local goals, and we're use us as a tool to meet your obligation, and so or meet your needs. And then we also on the single family side, we go out to towns all the time to try and because again it's not just affordable housing. There's kind of a whole life cycle of housing that you're going to have. You're going to need people may live in affordable housing now, but the idea being that eventually they'll move into rental home ownership units. So then we try to work with towns to make sure that their residents have access to this information and can take advantage of it.
Many of the local governments on their own websites will link to our programs, and about 40 or 50 of the municipalities in the state are contracted with us under the HAAS, our Housing Affordability Service. So we have a small team that works as an administrative agent for the townships to help them income qualify new applicants, make sure that the restrictive covenants are placed properly and adhered to when there's resale of these units. So there's private options, but then there's also an option where townships can use us and we help manage that for them.
Okay.
I have a question, which is maybe it's too basic, but I always wondered, based on the Mount Laurel, right? You have each town have a unit, how many units they have to met for the affordable housing. Is that can be combination of rental as well as the ownership?
Yes.
Or do you have a percentage requirement?
No, I think the only real percentage is there's, and apologies because I don't know, this is all part of, so the issue with, let me see if I can back up half a second. So Mount Laurel is obviously, for the viewers or the listeners, is a constitutional doctrine of the New Jersey Supreme Court about, the relation of zoning and police powers towards, access to people being able to live in, towns and school districts, et cetera, and trying to, provide
level to,
right. So that's there was then the legislature to enforce that, passed the Fair Housing Act in the 1980s. And then the administration of that kind of fell to the wayside in the 2000s and the 2010s. And so earlier this year in 2024, the legislature and the governor, passed and the governor signed what's called A4, which is a bill that kind of recodifies the existing procedures that had been taken over by the judiciary. So there are some changes in the calculations. And so I apologize if I'm not 100% accurate, but the only real areas where there are percentages are actually on caps. So there are caps for the calculation on, you have to have a minimum certain number of them have to be set aside for families. And then you have caps about your caps for only a certain number of your units can be senior. But really beyond that, there's no real differentiation. If a town wanted to, they could build them all for sale. Maybe hard depending on what their numbers are. But they could build all for sale. They could also build all rental. I don't believe there's any real delineation there. Probably would be best practice to do a little of both.
Yes, absolutely.
And then they can also get credits under the new statute. I believe they can get credits for recapture. So if they have units that are expiring, or that have deed restrictions that are going to end soon, if they re-up those for another 30 years, that would also count towards their obligation. So you can actually build your way that, and then there's bonus credits, right? Like if you're building for special needs populations, you're building for seniors, you're building for certain whatever, you can also get bonus credits. So it kind of takes down the total number that way too.
Okay. Thank you for that.
Yeah, that's very good information. I have a question about the fund, the Affordable Housing Fund that you said is eligible for any township that wants to use it. How does it work? Is it a loan to the township to provide the development funds, or is it a grant money?
So it actually goes to the development. So it's a loan that the development is able to take. So the way when you're building, affordable house, an affordable building. So let's say a 70-unit affordable housing built, like that's all affordable housing, and a 70-unit that's all market rate. They have to be built to functionally the same standards, right? You might have some differentiation on like cabinets and like your countertops, like, but functionally they have to be very similar in the structure. They have to be the same quality, and so the cost to build them is pretty much the same. The difference is when you're in an affordable unit, those rents are capped according to income, which means that it's not going to get this. So when you build out a fully market rate building, you're able to say, all right, this is the cost of it. This is what the rents that we're anticipating we're going to be able to get over 30 years are. And that creates a pro forma. And if the numbers work out where you're saying, yeah, the rents that we're going to get over the next 30 years can support the debt service it's going to cost us to build this, that works. The issue when you're doing this with affordable is that the rents that you're going to get back are not enough to sustain the debt service of the cost. So that's where like the low-income housing tax credit comes in. And we have a 9% credit that we give the credit to the property, to the developer. The developer sells it they syndicate it on a market, and somebody will come in, usually be like a big financing entity or whatever, like a Wells Fargo will come in and buy the credits. And in doing so, they're putting money directly into the project. That money accounts for usually about 70% of the cost. And by bringing that money into the project, it now means the debt service is only about 30% of the actual cost, which means that the rents that the property is going to get over the next 30 years can be sustained.
So it makes financial sense for the developer then to have that project because the rents will
correct
more
the
than
rents will
offset their debt service because it's been reduced by the third party lender like a Wells Fargo.
And so that's as you can tell that's an extremely competitive process. Now we have a 4% credit as well that is a little less. That only covers 30% of the development cost. So the production fund actually comes in to kind of stave off and like serve as like that missing 40%. So you have to meet certain standards. You have to agree to like affordability restrictions that are going to be like 45 years, et cetera. But what happens is the developer will come to us. They'll say, this is what we're looking to do. We'll say, they may apply for the 9% credit. If they don't get it, they might turn around and say, well, we would actually like to apply for the 4% and the production fund. They then obviously have to, as I mentioned before, they have to go to the town. The town has to say, yeah, we want this, we need this. And they come back. If it's in the plan, they can apply, and then the funding will be, we'll award it, and then, hopefully construction begins soon thereafter.
Wow.
Yeah, that's great. And let's talk about affordable housing, the definition. That includes both moderate and low-income housing, and that varies by region within the state of New Jersey, right? There's different income criteria based on the regional section. I don't want to get into the numbers because that's all over the place, but there could be a significant difference between in South Jersey somewhere versus somebody living very close to Manhattan, because the cost of living is much
Hudson
higher.
County versus Salem County are going to have very different average median incomes, and that's going to translate through on many of our programs, whether it's on the homeownership side, the maximum incomes that you're allowed in order to get into one of our mortgage programs, or on the calculation of what meets low and moderate income for that county or for that township when they're looking to get a rental.
And if that wasn't fun and confusing enough, then there are all kinds of different programs, right? So like the state has mandated certain housing regions exist, and HUD has certain housing regions that exist based on counties. So like, there's a lot of overlap, but sometimes the groupings don't always match up. So you might be, for the purposes of one HUD program, you might be in a region that is like, I don't know what it exactly is, but let's say it's like Middlesex, Union, and Monmouth. But for the state, you might be in a program that is actually, the housing region is actually Middlesex, Hunterdon, and Somerset. And so because of that, the incomes that you're calculating are different. So
and sometimes they're not even just different percentages off the same scale, but they're different scales too. So it's not just 100% of area median income, because HUD may define that differently than the IRS, differently than Fannie or Freddie on the median side.
It's confusing already.
It can be very confusing. One of the things that I did when I came in on the single family side, because we had not just different percentages, but completely different scales. It was very confusing for lenders to do it properly. And then there's a borrower whose closing hangs in the balance. So we simplified it, and where we had the latitude to, we moved to one scale with just different percentages on the scale. It's easy to calculate a percentage off of the same baseline chart, but when you have multiple baseline charts and multiple percentages, that's where it really starts getting confusing.
Right. And with the affordable housing, with the mandate, does the town have to build a certain number of low income and a certain number of moderate income, or do they get to pick and choose in that as long as they meet the overall criteria, or is that a loaded, complicated question?
I mean, it's a loaded question, and it is a loaded question. But the statute requires, I believe, that 13% are very low income.
Okay.
And then I don't think there's significant. Like you have to have then I think like 50% have to be combined for low and very low income. It differs it differs at the town level and it differs at the project level. So at the project level, you might be able to have like a lower percentage of very low as long as you meet a combined low, very low, moderate income. And then, but at the town level, you have like all of them combined have to meet a certain percentage.
Yeah, so it's a lot of
case by
lot of
case.
numbers, case by
but it
case.
is. I will say the one thing to note is the statute makes this a very town-driven process now. Like the new change makes it a very municipally driven process. So like the town council will set the standards of like what their obligations are. If there's disputes, it gets adjudicated through a whole program or whatnot. Our function in this whole ecosystem is we are going to help you once you know what your stuff, like once the obligation or the numbers have been decided and you've started to plan out where you're going to put your projects or whatever, right. That's where we come in and we'll basically, we with our financing, to some extent, we're almost like a housing bank. Like not actually a bank, but we function somewhat similar to a bank in the way that we will help you accomplish it once you've
identified what you want to do and how you want to do it, and then they can come to you through the different.
Don't blame us and all that, and the identifying and the setting.
There's a developer, and the developer is putting together their plan. They understand our guidelines, and they're going to put together a plan that meets our guidelines and is competitive within our goals in order to win those credits.
Yeah.
Yes.
Okay, very good. We're almost out of time. What's the best way for the townships to connect with you? Through your website? Do you want to share, or should that's all the information. There's a lot of resources on there.
And we have we have an email address. Yes. It's askstaff@njhmfa.gov.
Okay.
So askstaff, ASKSTAFF at NJHMFA.gov. It is the easiest entry point to the agency. It's managed by someone on my team. Usually it comes in. If you don't know where else to go, just go there and we'll direct you to the right place.
Okay, that's great.
The website is also, because sometimes people will misalign those letters. NJ Housing, njhousing.gov. That's all you can just Google. Just Google NJ Housing, you'll get there.
Yeah, that's a very very impressive website. So we did not get a chance to cover all the single family housing issues. So we'd like you guys to come back for the next week's show to talk about that and all the benefits you provide to the homeowners, home buyers.
Great.
Sounds good. So we're out of time for this show, but thank you guys so much for being our guests. We'll see everyone next week.
Thank you.